Hi, welcome to the Valuation Dashboard run through for the weekend of the 17th of August. What I wanted to focus on a couple of things this week. It's obviously been a very volatile week on the markets. Last week we ran through corporate bonds and how this time is different, that we haven't seen corporate bonds spread out, so the corporate bond market is pricing pretty much a normal type of spread for corporates, so there's sort of not that same concern about corporate going broke this financial crisis. Exhibition 2 in this crisis, this difference is for Australian. I'm looking at Australia. We're looking at Australian inflation-linked bonds here. So basically, taking an Australian government bond which is indexed to inflation, so if inflation's high you get a higher return on these types of bonds, and looking at what type of inflation the market is implying within the pricing of these bonds. So we saw in the just prior to the financial crisis, we had this huge blowout in expected inflation, so hitting 4.5%. When the financial crisis hit and concerns about it, concerns about a recession and concerns about deflation, we saw that reach lows of sort of 1% in terms of where it fell back to. At the moment, we're really very much in the everything's fine category. The RBA's band is 2 to 3% that they target. We're at 2.71%, so really it's an everything is normal type of situation. So very different to what we saw during the financial crisis of 2008. Jumping to a new table which we've got in the report. Just what we're trying to do here is actually show in a little bit more detail how we're getting to our asset allocation targets, and so we've put some 5-year target returns in. Just showing some of the higher level types of calculations that we're doing just to come up with the weightings that we do. So what we're looking at is the 5-year yield that you're going to get from each of these, whether it be cash, government bonds, corporate debt, residential property, Aussie equities or international equities. Then there's this valuation normalisation in order to get back to a longer term value. So what we're saying is over this 5-year period, at some stage each of these will pass through its longer term average or our longer term expected return based on the types of cash flows you can generate from these and the risk within each of these assets. So bonds, we're looking, they're a little bit overvalued at the moment for the government bond yield, so there's going to be some sort of valuation normalisation there. Corporate debt, very minor. Residential property, we do think there's a fair bit of valuation normalisation that will need to go on. We're not talking about a 35% drop within the actual value, but what we're talking about is a longer term period of this asset sort of going sideways and some of the income sort of making a catch up there. Aussie equities we think are undervalued. It could take a while before we see that come back though, and similarly on international equities. Then there's a change in spread, which is really only valid for the corporate debt, but we're not expecting any major effects there at the moment. Then the change in income. So what we're expecting income to grow at over the 5-year period. Change in Aussie dollar will affect international equities as well, and that gives us a total return over the 5 years, and then the average annual, which is the one which we focus on. Not to say though that even when you're expecting these value normalizations, these can take a very long period of time. So sometimes we can be talking about years before you see the value actually come back. So while some of these numbers will look high, it doesn't always mean our asset allocation will line up perfectly with it, as there are timing, momentum, and changes in income differences. Sometimes we're on, we might be expecting a positive income, but you're on a negative slant, so that you have several years of negative income before you see a bounce back. And just to illustrate that a little bit further, we saw government bonds were expecting a relatively negative effect over the next few years for Australian government bonds. It's worth noting though that they're still very attractive from an international perspective. So just showing here the implied inflation from inflation-linked bonds versus the 10-year bond rate on a whole bunch of different countries. If you're above this vertical line, you've basically got negative real yields. So the further away from that line you can get, the better your real yields on your bonds are. And you can see that obviously Australia looks very positive there. Italy also does, but that's partly explained by by the lower graph here, which shows the risk versus return. So the risk of default. So Italy very high there, Australia very low. So which is why Australia looks very positive.